Every single year, there are a lot of people that start investing or want to start investing in the stock market, but everything looks so difficult and complicated. The 2020 pandemic accelerated that number of people as we saw a lot of people investing or trading during lockdowns, so I believe this video will be very useful for many of you guys. Hello everyone, welcome back to the channel. Today, I want to talk about everything you should know about the stock market as a beginner and how the greatest investor of all times does it. If you're new here, welcome. If you enjoyed the video, consider subscribing and smashing that like button since it really helps the channel out. But before talking about Warren Buffett, the greatest investors of all time, his thoughts and how he does it, let's start with the stock market itself. What is a stock? What is a stock market and more? So check timestamps down below in case you're interested in other topics first. First of all, I understand there are different types of investments. You can invest in real estate, crypto, stocks, or physical business, or gold and more. The question is, why do I believe the stock market is the best type of investment if you are starting right now? Because it does not require a lot of money to start. You can start with $100, $1,000, or millions of dollars, and you will be more than fine. Instead, in real estate, for example, you need to have money saved up to pay the down payment and have a good credit score and credit history. I believe investing in stocks is the easiest and fastest way to start investing and building up wealth without struggling with inflation, for example. In my opinion, it is excellent that you save money for any kind of situation, but in moments like today where we have a high inflation, your money saved up is losing you money. But what is a stock? A stock is simply a share of a company. So let's say that you like Apple as a company, just like me, and you would like to invest in it because you see potential and more. So if you buy one share of Apple, you will be owning a little piece of that company, in this case Apple. Just like a slice of a pizza, for example, you would be buying a slice of a whole pizza by buying a share of a company. So with all that said, how do you buy a stock or share of a company? First of all, we need to open an account in a brokerage you like the most. I have tried Webull, M1 Finance, Robinhood, Fidelity, and TD Ameritrade. I mainly use Robinhood as I started with them and stayed with them so far, but you can use the one that you like the most. If you want to open an account with Robinhood, Webull, or M1 Finance, I have affiliate links down below, so you can get 1 free stock with Robinhood, 5 free stock with Webull, or $50 with M1 Finance. After you open an account with any of them, or others that you prefer, and deposit money, you will be able to start buying shares of the company that you like the most, the one you have done research on, and more. If you have any doubt with this step, you can contact me through my email or Instagram, and I will be more than happy to help you out with your brokerage account. Now, something very important to understand is that it is obviously risky to invest in the stock market. Heck, it is risky to invest in anything, but I can say that there are strategies available that could help you make it less risky or easier. Because, for example, a question that I receive a lot is, what happens with my money if the company that I invested in goes bankrupt? And the answer is that you will lose all your money. Obviously, it is very difficult to see that happening to every single company, and even more to strong and big companies, which is why I always say that the best way to invest, if you decide to invest in individual stocks, is to invest in big, strong companies that are excellent financially speaking and will be able to surpass any rainy day without any problem. Companies that maybe did not struggle much during the pandemic or a war or a crisis because they have healthy financials. What I want to say with this is that you need to understand that by investing in the stock market, there is always a minimal risk, just like if you invest in real estate or create your own business. The only place you might not lose your money is in a savings account, but the value of your money will decrease because of inflation, so you're basically losing money. That is exactly why when analyzing a company, you should check their balance sheet, their income statement, their management team, their debts, their assets. Those companies that you invest in need to have uptrend revenue and net income if they are profitable. After knowing all that, you need to decide which type of investor you want to be. If you want to invest in index funds or in individual stocks, and if you decide to invest in individual stocks, would you prefer to be a dividend investor, a value investor, or a growth investor? First of all, between index funds and individual stocks, is an easy decision in my opinion. Do you want or have the time to put into research, analyze their balance sheet, their income statement, their earnings, listen to their conference calls and more? If yes, then you will be able to invest in individual stocks. If not, then index funds is the way to go for you. What is the difference? That by investing in an ETF or an index fund, you will be investing into a more secure or less risky thing with less time consuming required, less risk but less gains as well. For example, if you invest in the S&P 500, you will be investing in the 500 biggest companies in the US, which are all this, such as Amazon, Apple, Facebook, Tesla, Microsoft, Pfizer, and many, many more. Investing in ETFs is easier and less volatile. As we can see, the S&P 500 have had an annual average return of 13.6% in the past 10 years, for example, which is excellent, way better than keeping your money in a savings account. And you will be battling inflation. Well, you did not need to do anything else than just investing your money in it and forget about it. Remember that generational wealth is built by investing and then doing nothing, just waiting and waiting while you invest and more and more. Now, if you decide to invest in individual stocks, you have the possibility of having higher returns but higher risk as well. If you are able to catch the right investment, the right company, you will have higher return than investing in an index fund, for example. But even though it sounds that easy, it is not, and you will most likely make some mistakes along the way, but in the long term might be worth it, depending on your investments, just like I have done, many retail investors have done, and even Warren Buffett has done. Talking about Warren Buffett, who is he and how does he invest? Warren Buffett is known as the world's greatest investor, which I assume you have heard of him if you are watching this video. He's the CEO of Berkshire Hathaway, which is a conglomerate holding company, and they basically invest in companies like Apple, Bank of America, Coca-Cola, Kraft, Chevron, and more. But we can see that the average annual return for Berkshire is about 20%. We can see that in the past 5 years, the stock is up 109.17%. Even year to date, it is up 17.28%, while the S&P 500 is down 6.10%. So how does Warren Buffett do it? What is his strategy, and what does he focus on? There are many, many lessons we can learn from Warren Buffett, but today I want to talk about 5 or 6 I believe are very, very important for any kind of investor. The first one is to invest in wonderful companies, excellent companies, not cigar butts companies like he said once. The way he explains it is that you are, let's say, looking to buy cigarettes, walking on the streets, and you find this already used cigarette that has one puff left, at least, so you take it, you inhale it, for that one last puff and throw it away. So you go and try to find another one just like that one, just because they are cheap, but does not mean it is a good one. But that is not sustainable long term. You can make money with it, yes, but it is better and it is much easier to buy a new pack of cigarettes, which is the same to buy wonderful businesses at a fair price. What he meant with this is that we should not focus on buying beaten down companies trading really cheap just because they are cheap. We should invest in companies, in wonderful companies at a fair price because they are wonderful and because of what they do, not because they are cheap. And I completely agree, as there are many companies out there that are excellent, and we can find others that are at excellent prices but are not good companies to invest, which sooner or later might go bankrupt and you will lose your money. The second lesson we can learn is that goes in hand with the last one or the first one, and it is to only invest in things that you understand. Does not mean that you need to fully understand the product, the technology, or the product that the company is selling. Obviously, it's a good idea to understand it, but Warren Buffett refers to fully understand the business, the economics of the business, how they are looking right now and how they are going to look in about 5 to even 10 years from now. Evaluate the company and understand what they do, the economics, the competitive aspects of the business, and more. If you're able to understand and analyze all that about a company, you are off a good start with that investment. The next lesson is to never ever invest based on emotions. Invest based on facts. We see nowadays a lot of people investing in crazy companies just because others made money out of that company, or just because another company similar to that one grew massively, so this one is most likely going to grow massively as well. Analyze companies and invest by facts. What the company is doing, why they have potential, why they will be big, why they will be key companies in the future, and so on. Do not buy or sell just because everyone else is buying or selling, which is why Warren Buffett's most popular quote is to be greedy when others are fearful, and fearful when others are greedy. If you decide to sell a business, or a stock, it is because of the fundamentals of the company that are changing, or because you disagree with the decision of the management team that they has just made, or because you believe your money will be better off on another investment. But never ever sell because the stock is down, and never ever buy just because the stock is up. Now, the stock market is not difficult to understand. You are able to do it. You are able to invest your own money in it if you believe in yourself and you do your own research. You should not overcomplicate things, because it is then when mistakes are made which makes us lose money. When you see a great opportunity in the market, take it. Don't pass on it. We don't see many opportunities on a daily basis, but we do get the chance to do something right and big. You gotta take those opportunities, because most likely will give you a nice return in the long term. Again, long term. Focus on the long term return without caring about short term volatility. Hope you enjoyed the video. I will leave you here a video recommended by YouTube, and here for you to subscribe. Thank you, and see you next time.